The crisis that will change a generation is a topic that has been gaining prominence, especially in discussions about global economic health. Jim Rickards, a renowned economist and author, argues that the current financial crisis is not just a passing anomaly, but rather a transformative event that could shape the economic future of an entire generation. Rickards emphasizes that the consequences of this crisis will be profound and long-lasting, affecting not only financial markets, but also the way societies and economies organize themselves. One of the central points of his analysis is the identification of vulnerabilities in the global banking system. He points out that many of the largest banks face alarming weaknesses, especially those with assets in the range of $200 billion to $900 billion. These institutions, although considered relatively large, can be susceptible to economic shocks and liquidity crises. The focus on mid-sized banks reveals a critical aspect: the weaknesses that hide behind large financial institutions and how their interconnectedness can propagate a crisis quickly and devastatingly. To better understand the health of banks and their ability to withstand future crises, Rickards proposes a three-tiered approach. This methodology involves a detailed analysis of various financial and operational aspects of banks, starting with basic financial health, such as capital reserves and assets. The second tier considers the interdependencies between banks and how lending relationships can amplify risk. Finally, the third tier looks at the resilience of community banks, which are often overlooked in broader analyses but play a crucial role in local economic stability and lending. By taking this comprehensive approach, Rickards believes it will be possible to not only identify banks that are at risk, but also to implement measures to strengthen financial security before the crisis deepens further. This analysis is not just diagnostics. It is a call to action for investors, regulators, and banks themselves to recognize and address vulnerabilities that could have a lasting impact on the global economy. The message is clear. The crisis we are experiencing is more than just a relapse. It is an opportunity to reassess and reshape the foundations of the financial system with an eye toward a more robust and resilient future. The history of sound banks reveals a trajectory marked by resilience and adaptation in the face of significant financial crises. During the Panic of 1907, which caused a liquidity crisis in the United States, institutions such as J.P. Morgan stood out by intervening in the banking system, organizing a consortium of banks to stabilize the economy. This event highlighted the importance of sound banking institutions and their ability to weather crises. Later, in the Great Depression of the 1930s, many banks faced collapse, but some institutions, such as Bank of America and Wells Fargo, managed to survive and restructure themselves, becoming pillars of the financial system. In the current context, globally systemically important banks, such as J.P. Morgan Chase, Citigroup, Morgan Stanley, and Goldman Sachs, play a crucial role in the international financial system. These institutions are so large and interconnected that their failure could trigger a large-scale crisis of confidence, affecting economies around the world. The status of systemically important bank implies more stringent regulatory oversight, in addition to requiring these institutions to maintain adequate levels of capital and liquidity to mitigate potential risks. Concerns about bank failures are a relevant topic that resonates with both depositors and shareholders. For depositors, the possibility of a bank failing can create uncertainty about the protection of their deposits and the ability to access their funds. On the other hand, shareholders are aware that a failure can result in significant losses, as well as affecting the reputation and stability of the banking sector as a whole. This concern highlights the importance of effective regulation and risk management practices, which can help prevent crises and protect the interests of both depositors and investors. Confidence in the financial system is fundamental, and history shows that strong institutions are essential to ensuring that confidence in turbulent times. Safe deposits are a key concern for anyone who keeps their savings in financial institutions. The Federal Deposit Insurance Corporation, FDIC, is an independent agency of the United States government that provides deposit insurance to banks and thrifts. This insurance covers customer deposits up to a limit of $250,000 per depositor, per insured bank, for accounts such as checking, savings, and certificates of deposit. Once deposits exceed this limit, amounts above $250,000 are not protected, which poses a significant risk, especially in times of financial uncertainty. This means that if a bank fails, depositors could lose part of their savings. A telling example of the importance of deposit insurance was the failure of Silicon Valley Bank, SVB, in March 2023. SVB, which had a large concentration of clients in the technology sector, saw its operations quickly collapse due to massive withdrawals of deposits and the decline in the value of its assets. One alarming fact about this situation was that approximately 97% of SVB's deposits were not insured by the FDIC. This left most depositors in a precarious situation, as they lost access to a large portion of their funds when the bank declared bankruptcy. The lack of coverage meant that many investors and businesses that relied on SVB for their day-to-day operations faced severe financial consequences. Furthermore, in the digital age, the speed with which deposits can be withdrawn today is a critical issue. Technology allows customers to make instant transfers and withdrawals at any time, which can amplify banks' vulnerability. In contrast to bank runs in the past, where people physically went to branches to withdraw their funds, today's runs can happen in a matter of minutes, with customers simply clicking buttons on their mobile devices. This dynamic makes bank liquidity even more critical and exposes financial institutions to greater risk, especially in an environment of economic instability. The combination of the FDIC coverage limit, the SVB failure, and the speed of digital withdrawals underscores the need for depositors to be aware of the risks associated with storing large sums of money in banks, especially when those amounts exceed the protection offered by deposit insurance. The price of gold and the strength of the dollar are intricately and fascinatingly intertwined, reflecting not only market dynamics but also global economic sentiment. When we see a rise in the price of gold, it often indicates a weakness in the dollar. Gold, traditionally seen as a safe haven in times of uncertainty, tends to attract investors when confidence in the U.S. currency wanes. This is because, in times of crisis or instability, investors seek to preserve their capital in assets that are not tied to the traditional financial system, and gold stands out as a store of value with a long history. To better understand this dynamic, it's important to consider how currencies compare and how we measure their strength. Often, the value of a currency is measured against others, but this doesn't provide an accurate picture of a currency's true strength. Using the analogy of a lifeboat, we can see that just because one boat floats doesn't mean it's stronger than one that's sinking. Similarly, a currency may appear strong relative to another at a given moment, but this can be influenced by a number of temporary factors and doesn't reflect its true stability or purchasing power. A currency's strength should be assessed in a broader context that takes into account the country's economic health, inflation, and consumer confidence. The nature of gold as a currency is an even more intriguing question. Unlike government-issued currencies, which are essentially a form of debt, gold is considered money that owes nothing to anyone. This characteristic gives gold a unique and enduring quality, making it an asset that can be used as a hedge against inflation and monetary debasement. While fiat currencies can lose value due to monetary and fiscal policies, gold, because of its scarcity and constant demand, maintains an enduring appeal. So when we look at the price of gold relative to the dollar, we are not just looking at numbers on a chart, but rather examining a broader narrative about economic confidence, wealth preservation, and the nature of money itself. Expectations for gold. The gold market has been a growing focus of attention, especially as concerns about the U.S. government's debt intensify. With debt surpassing the $35 trillion mark, investors are increasingly looking to gold as a safe haven asset. Gold's store of value nature becomes more attractive in times of economic uncertainty and rising inflation. The expectation is that as debt levels rise, the price of gold will continue its upward trajectory, as many investors view the precious metal as a hedge against currency devaluation and financial instability. When considering the current economic landscape, it is essential to distinguish between technical recessions and a prolonged depression. Technical recessions, which are generally defined as 2 consecutive quarters of economic contraction, can be followed by periods of rapid recovery, while a prolonged depression, such as the one Japan experienced during the 1990s, involves a persistent decline in economic activity, stagnant prices, and high levels of unemployment. Japan is a clear example of how an economy can suffer the effects of inappropriate monetary and fiscal policies, resulting in a lost decade. This distinction is vital for investors, as the type of recession a country faces can significantly impact the demand for assets such as gold. Economic growth in the United States is also closely linked to fiscal policies and budget deficits. Rising government debt has been accompanied by a series of fiscal stimulus measures, which, while potentially temporarily boosting growth, raise questions about long-term sustainability. As the government continues to finance its operations through debt issuance, budget deficits can undermine investor confidence. If confidence in the government's ability to control debt diminishes, gold could benefit, as many investors may turn to it as a viable alternative. Expectations for the future of gold are therefore shaped by these complex economic dynamics. As awareness of gold's usefulness as a hedge against inflation and financial uncertainty increases, demand for this asset is likely to grow. While awareness of gold as an investment may be limited among the general public, as the economy becomes more unstable and public debt expands, more investors are likely to consider gold as a crucial part of their portfolios. This could result in a significant increase in the price of gold, reflecting its growing importance as a safe haven asset in times of economic crisis.